Welcome to Talk Tickers. Today, we're breaking down the Q2 2025 earnings call for refiner CVR Energy. That's ticker CVI. The market reacted, let's just say, pretty harshly, sending the stock for a dive. So let's get into what spooked investors and what the company's game plan is now. All right, let's just dive right into the market's reaction because it was swift and it was pretty darn clear right after that July 31st call. The stock took an immediate and pretty significant hit, closing down over 5% on some heavy volume. And it got even worse in after-hours trading, dropping around 8%. Ouch! So what drove all this negativity? Well, it's all about the disconnect between the top and the bottom lines. You see, they had a solid revenue beat, which is great, but it was just completely overshadowed by a huge miss on earnings. To really get to the bottom of that earnings miss, we have to unpack two key issues that just weighed so heavily on the quarter's results. And you don't have to look far for the cause. The outgoing CEO, Dave Lamp, he pointed directly to the main culprit, this massive non-cash charge related to something called the Renewable Fuel Standard, or RFS. $89 million. I mean, that is a huge paper loss, and it had a massive impact. It pretty much single-handedly flipped the company's GAAP EBITDA to a $24 million loss for the quarter. Now, it's really important to understand that this isn't an actual cash loss. It's an accounting adjustment. It basically reflects a future liability. But you know what? A number that big, even on paper, was more than enough to spook investors. And on top of that whole regulatory headache, their operations were intentionally slowed down. They had just finished a huge maintenance turnaround at their Coffeyville facility back in April, so things were still ramping back up. So, with all those headwinds, let's see how the company's different business units actually performed, because this is where things get interesting. And this table really illustrates the dynamic perfectly. The petroleum and renewable segments really struggling. But then you look at the nitrogen fertilizer segment, it was the absolute standout performer, providing this crucial $67 million in EBITDA that really helped prop things up. The call wasn't just about this one tough quarter. Management actually spent a good amount of time laying out their path forward, and that includes a pretty major leadership transition. So, a planned succession is already in motion. You've got industry veteran Dave Lamp retiring at the end of the year, and Mark Pytosh is all set to take the helm, which should ensure some strategic continuity. And despite that headline loss, management was really trying to project confidence. They're focused on strengthening the balance sheet, and now that the big turnaround is finally done, they're looking to capitalize on what they see as improving market conditions. So this is the crucial point, right? How do you weigh this backward-looking earnings miss against what could be a much better operational recovery going forward? It really is a classic battle between a bullish operational setup and this bearish regulatory and sentiment problem. The bull case is solid, but that bear case with the RFS risk and weak sentiment, that's a tough one to ignore. And that brings us to the final call for our subscribers. Where do we see this stock going? Okay, so our reading is market perform. We think the stock is probably going to stay range-bound for a while. Why? Because investors are going to wait for solid proof of sustained operational execution to really outweigh that persistent regulatory uncertainty from the RFS. This is not financial advice.